Republicans are promoting President Trump's pre-pandemic economic track record as one of the strongest indicators of his success. During the national convention this week, speakers have repeatedly pointed to the nation's steady economy before the coronavirus hit. They argue Mr. Trump is the man best equipped to get it back on track. However, the latest CBS News Battleground Tracker poll shows Democratic voters are far less optimistic about the state of the economy. While 67% of Republicans say the economy's condition is good, only 35% of voters overall feel the same way. For more on this, let's bring in Axios markets editor Dion Rabouin. Dion, thank you very much for being with us. How are we seeing those concerns reflected in consumer confidence?
Yeah, in a word, consumer confidence is bad. It's down. It's near the lowest it's been in more than 6 years. In terms of numerous reports, you've got the Conference Board's report that just came out a couple days ago. You've got the University of Michigan report that came out a couple weeks ago, and both show consumer confidence plumbing lows, even as the stock market has taken off and taken flight, even as the housing market has taken off and taken flight. You're seeing consumer confidence stay low. And again, it's at the lowest levels it's been in about 6 years, since long before President Trump came to the White House.
Well, you mentioned this positive outlook by Wall Street. Why this disconnect between Wall Street and Main Street?
Yeah, that is the big question right now. Stocks have been booming since March 23rd, when the Fed stepped in with its QE Infinity program. Stocks are up more than 50%. The NASDAQ has reached a number of new all-time highs. It's up about 50% from where it was a year ago. So Wall Street is content to just ride that wave, to buy the dip, and to, play the game as it goes. Whereas households are seeing, you're seeing record job losses. You are seeing business closures at a rate that's the highest we've seen since the Great Recession. All these things that affect so-called Main Street are looking really bad, even as the stock market continues to take off and reach these new all-time highs on the S&P 500 and the NASDAQ.
Well, last night we heard White House economic advisor Larry Kudlow characterize what, in his view, is the improving economy. Let's go ahead and listen to a little bit of what he said.
Right now, our economic health is coming back. With emergency spending and tax cuts, Americans are going back to work. There's a housing boom, there's an auto boom, a manufacturing boom, a consumer spending boom.
Dion, what's your assessment of those statements?
It's like a lot of things the Trump campaign and Trump himself says. They're all true, technically, but without context. So we are absolutely in a housing boom. Objectively, 2020 has been a great year for the housing market if you take out those lockdown months of May and June. And if you look at the auto sector, absolutely booming. Manufacturing is coming back if you exclude jobs in terms of sentiment surveys. But if you step back and you look at the big picture in terms of where are we this right now in the month of August, or where were we in July versus where we were in January, we're still down. The economy is still significantly in worse shape than it was at the beginning of the year, and where it was in February, and really where it was last year. GDP this year for the U.S. is not expected to grow to what it was in 2019, as in it's going to be negative this year, and economists expect GDP to be negative next year and potentially even in 2022, as in below where we were in 2019. So this economy is clearly, it's moving backwards, but we are growing from that hole, that massive hole that the coronavirus pandemic put us in March, April, and May.
Well, nationwide unemployment is around 10%. What are you expecting, Dion, from this week's unemployment numbers?
That's a great question, because on the one side, you've got an economy that is slowing. Job gains have been slowing. Job losses have been accelerating. You're seeing more layoffs than you had in the prior months. In May and June, you really just saw workers going back to work in huge numbers. That has dissipated and really could be washing out. And you could potentially see a negative print, though that's unlikely just because of the massive number of people who lost their jobs from March through May. A lot of those people are coming back to work. But what we're also seeing is a number of new companies having to lay people off that didn't necessarily have to lay people off before. It's a kind of new wave and what I call the second jobs apocalypse that's happening right now. It's a lot of white collar workers. A lot of these businesses and companies that weren't directly impacted by the coronavirus pandemic didn't have to shut down. They're now seeing that their business models don't work. They're not able to make sales and generate revenue at the pace they would need to stay in business. A lot of them are shedding staff, and a lot of them are just shutting their doors. So it's going to be very interesting whether we can maintain forward momentum for August, because a lot of the real-time data indicators that the New York Federal Reserve tracks, that a lot of the banks on Wall Street track, have been showing a consistent move in reverse or a stall out into neutral over the past month or so.
Finally, Dion, the Congressional Budget Office projects the federal budget deficit could hit a whopping $3.7 trillion this year. What are the potential consequences of another tax cut like the president wants, or if Congress approves more funding?
Yeah, that's a great question. And we are really learning through trial and error and by doing about whether or not all these things that conservative Republicans and folks who cautioned about the budget and the national debt and the national deficit, we're going to see if they were right. And we're also going to get a chance to see if this modern monetary theory, MMT, has any merit. Because if Democrats or Republicans, whoever's in charge in January 2021, wants to keep this economy from falling back into another hole, we're going to have to spend more. This $3.7 trillion is probably going to grow. It's probably going to be closer to $4 trillion by the end of this year. We're approaching the end of the fiscal year, but Congress still has more spending to do. Wall Street is expecting another $1 to $1.5 trillion of spending to come from Congress after Labor Day. And it's necessary spending because the economy just is not moving because the coronavirus has not been contained. So again, whoever's in office in January is going to have to authorize more spending because we're going to need some stimulus to get this economy picked back up. That's probably going to come from tax cuts, additional spending, new programs, things like that. And we're going to see these budget numbers balloon. The U.S. debt to GDP is at the highest it's ever been, the worst it's ever been, and that number is poised to get worse, not better. And look, the Federal Reserve economists that I talked to, both on the right and on the left, have said this is no time to be worried about the deficit. Treasury Secretary Steve Mnuchin said we're in a war with this virus and we've got to beat it, and that means spending. And so this debt hole that the U.S. is in is only going to get bigger. And we've got to hope that interest rates don't spike the way, the deficit hawks have warned for years. We've got to hope that the country doesn't, quote unquote, go bankrupt or, have to turn to any sorts of other forms of funding, that people still want to buy U.S. debt. Right now they do. The debt markets are working great. The Fed is keeping interest rates low, and there's no reason for panic. But we'll see. We're going to find out just how far we can push the bounds of fiscal policy and spending and debt finance spending here in the next year or so.
Just so much uncertainty, but truly we are in an emergency situation. Dion Rabouin, Dion, thanks very much for sharing your insight with us.